Good morning and welcome to the ADS Securities Markets Update. The US jobs report came in with good outcomes, but at the same time without beating the estimates. However, last month's revision, in addition to the decline in the U6 unemployment rate and the pickup in the month-over-month wages, increased the chances for rate hike in September. According to Bloomberg, September's rate hike probability ticked up toward from 50% to 58%, while December's chances also increased toward 80%. Regardless, more evidences would still be needed to confirm this. The U.S. economy added 215,000 new jobs, slightly less than the market estimated, which was around 225,000. The previous reading has also been revised up toward 231,000, up from 223,000. The unemployment rate also remained at 5.3 as widely expected, but the U6 unemployment rate also eased back toward 5.3%. Wages growth hasn't showed the desired change. As widely expected, we had also the month-over-month increasing by 0.2%, but the year-over-year managed to disappoint by increasing toward 2.1%, up from 2%, even when it had been anticipated to rise toward 2.3%. After the U.S. jobs report on Friday, we maintain also our neutral outlook, or our position for neutral outlook regarding September's rate hike. The jobs report, of course, showed a solid summer employment, but at the same time, wages are still short from the latest highs, which is 2.3%. September's rate hike also needs more confirmation, which might come in from August jobs report, and therefore we prefer to wait for further evidences until then. The US dollar spiked across the board right after the announcement. However, the bond market wasn't convinced with September's rate hike, and the US 10-year yields declined back toward 2.16% and closed the week on these levels, which is also the lowest level since August 4th, closing the day and the week with bearish engulfing on the daily chart, and on the weekly chart we have a bearish shooting star candle for the third week in a row, which also increased the chances for further declines in the next or during the week ahead. In return, the US dollar profit taking may continue also, and this is the US dollar chart on the daily, which basically failed to break above its resistance level, which is around like 98.20, and continue to decline and close the week around 97.16. So the bearish outlook remains as far as it remains below that level. But at the same time, profit taking may continue this week amid a few economic releases throughout the week from the US. During the weekend, we had more disturbing news from China, which increased also the chances for further intervention by the People's Bank of China in the coming weeks. In addition to that, and likely to keep the oil prices under pressure. The trade balance declined, or the trade balance surplus declined by almost 10%, declining toward 43 billion, down from 46.5 billion for the past 2 months, while it had been anticipated to rise again to 53.4 billion. This is the lowest surplus since April of this year. In addition to that, the exports declined by 8.3%, while imports also continue. And this is the biggest and the first and the biggest monthly decline since March of this year. And the imports also continued to decline for the 9th month in a row, declining also by almost 8.1%. The inflation data also from China yesterday showed also mixed outcome over the weekend. In addition to that, we had the CPI, or the year-over-year CPI, advancing toward 1.6%, up from 1.4%, while estimates were to rise toward only 1.5%, and this is the highest level since October of 2014 or of last year. Finally, the PPI declined by the most since the financial crisis, unfortunately declining by 5.4%, which is the biggest monthly decline since October of 2009, and the longest declining streak also on a record. As for today, during the Asian session, there were also few economic releases from Japan, which had a notable impact on the Japanese yen this morning. The current account surplus narrowed back toward to almost 1.3 trillion yen, down from 1.64 trillion, while it had been anticipated to decline toward 1.41, and this is the lowest in almost 2 months. As for today, the day ahead, there are no significant economic releases throughout the day, while the U.S. session may experience a high volatility, as there are only 2 FOMC members will be speaking today, including Fisher and Lockhart, which may hint for a rate hike in September again, and this is likely to have notable impact on the market, just like what happened last week. That's it for today. You can follow us on our social media sites at Twitter, Facebook, and YouTube to get the latest economic releases, reports, and analysis. I'll see you once again tomorrow. Have a good day.